for other people who don't have experience, what you have to do is you have to find the investors first before you find the opportunity. And that's the most important thing. Start building relationships with these smaller investors. Everybody knows social media today. Attention is the new oil. Get on top of that, put together an email list and start talking to these people.
The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus. Putting the guru in the show today with Mr. Salvatore Buscemi, who is one of the very rare third-time appearances on the Apartment Gurus podcast. Sal is a capital raiser extraordinaire, has done some really cool projects, is working on a cool one right now inside the commercial real estate and elsewhere. Has a tremendous book called Investing Legacy. Did I get that right, Sal?
Yeah, Investing Legacy, how the 0.001% invest. You got it.
Yeah. So last episode we were looking back. We're not sure that this is true, but we say it looks like it was about 2 years ago, which seems amazing to me. But that episode itself is worth revisiting. So, and I don't have the number in front of me, but it's Salvatore Buscemi. It's called Calling the Capital. And if you want a masterclass, and there you go, there's this book, Calling the Capital. If you guys want a masterclass in the world of raising capital, the way the big boys do it, as Sal said, is his specialty is the 0.001%. It's a great episode to check out, and we're just going to kind of pick up on things from there. Things have changed so much especially in the real estate space, but really in the equity space in general. Sal, just kind of give us your take on things now. What you're seeing and what you're excited about, what you're not excited about, and all that good stuff.
We're all over the place as far as it relates to privates. Brahmin Partners invest in private direct real estate deals, private direct companies, nothing public, no ETFs, no Bitcoins, NFTs, or anything like that. Just private stuff that we have some sort of control or discretion over. We do not make fund investments, although I do have a fund. It's not, I advise people not to do that and to use SPVs. But, it's very interesting to see how the monetary flows have been happening over the past, say, like 2 years and things. And I think there's really pointing to some good trends from multifamily investors that, we can talk about and how I would raise money from high net worth clients around that going forward. Yeah. But I think there's a lot of excitement going on today if you want to get down to it, but maybe it's not all good excitement. And I think, you're starting to see the most powerful country in the world right now come to an inflection point that's not now between the election, but rather between the election and the 79 days to inauguration day. And at that point, anything can really happen. My concern is not really with interest rates or anything like that and I don't think what's really not going to change is because you still have very, very powerful people who are wealthy, who are in charge of everything. You just want to make sure that the U.S. is still a safe place for rich people from all over the world to invest in. Yeah. And, I don't need to tell you where you are right now, but, there's a lot of money coming from Mexico into the United States. Yeah. China, too, even though that's much more prohibitive to do. It requires a lot more regulation. But we're seeing, those trends happen that way. I actually have to head out after Labor Day and meet with some Asian families out in the Orange County regarding some, real estate deals that we'll be going into, and to, sort of talk to them about that, and really not just sell them, but train them on it. Right. And there's a way that I do that, because not everybody's a real estate investor, but they're smart enough to know what they do know and what they don't know.
Yeah. Yeah. Well said. A number of things actually in all of that, but real quick to rewind to your comment about funds, just to get a little clarity on that. You said you would advise folks not to do that. Do you mean on the fund management side, you advise people to stick with SPVs on an individual project level versus like a general fund model?
Absolutely. And the reason is because fund is a 4-letter word with wealthy people today. They see it as someone who's really good at raising money, present company excluded, but they use that to their advantage. So if you raise $1 billion, 2% of that is what, $20 million. I mean, that doesn't incentivize most sponsors or GPs to take risk, right? So, it's sort of like there's no reason to sort of shake the tree, or to kick the dog if it's sleeping. And the reason is because if you take too much risk, people might get upset, pull out, and then your AUM goes down, and so does your management fees. But also, I think it comes down to it is people want to have some sort of an understanding of what they're tangibly investing into. And I think the fund structure is great for institutions, but not everybody's a BlackRock here. And you got to start building a brand out first. And by doing that is by pinpointing projects that either you or someone more successful than you that you can raise capital around. And it's much easier to do it that way than a fund. And a lot of people that get into the fund management business, they don't really understand the complexities of it. They just think it's a cheaper alternative to using other structures because it's a boilerplate document with a management company and classic GP/LP structure, which I talk to a lot of people about. Yeah. The issue is you don't know what the fund's investing into, and do you really trust the guy who's doing all the work to make the investment decisions? And is there an accounting of the funds, that's present with that? A lot of these fund managers, they just hire like their cousin who's an accountant to do the fund accounting, and he really doesn't. And that's sort of, these are things that people intrinsically think about. They're like, well, I lose control. I don't have any discretion. What if he invests in something I don't want to invest into, like an RV park or, something that goes outside of it? And the biggest, and through my experience and listening to hundreds of pitches since moving to Florida, which is the epicenter for people wanting to raise capital there in Palm Beach, is the fund structures they just get kind of pushed by the side because nobody wants to be in the dark about what's being invested into and what basis. And if you're looking at things from an individual project level, you have more of an understanding of what this person's going into rather than, what they might go into that you don't think is going to be a good investment.
Just to play devil's advocate a little bit, because in full transparency for listeners, we at Greenlight, we're still raising essentially the SPV model per investment, per asset that we're acquiring and investing in. However, we have been really hedging towards looking at a fund model, and I think specifically, and this, I guess this is the point I want to ask you about, is we would have a very specific definition of our criteria, our buy box, if you will, even down to a particular market, even down to particular submarkets. We're in Columbus, Ohio. We're extremely bearish on Columbus, or bullish rather, and we're extremely bearish. But we love Columbus for a lot of reasons, and I'm very confident there. We own 5 properties there. We just sold one. We were up to 6, and we're acquiring one right now. And we're also specific about the asset itself. We're staying far away from any sort of heavy lift value add, Class C, so B plus 2000 vintage or newer.
Specificity. I love that. Yeah.
Right.
So you're going to be dealing. Go ahead. I know.
So that's my point. And my question is, some of these funds will have a very, there's people that I know that have, Airbnb or, nightly rental funds, and they only invest in nightly rentals. I don't know that they're bound by law to only invest in nightly rentals. They probably are not, is my guess.
Well, it depends on how the docs read. It's not law, but the point is that what you're dealing with is going to be much larger, and what you don't want is cross promotes. Meaning, if you have one that you swing for the fences and you get a home run, and then you strike out 2 times afterwards because of market forces or legislation, reasons or whatever. Right. Maybe another pandemic comes, a lockdown. I mean, nothing can be out of the question right now today, right?
Yeah.
That could affect the whole overall mission of the fund. And as a GP, you want your incentives tied to the performance of the asset, not the performance of the fund, where you can't, where you want everything to be sort of compartmentalized. And what we do, and it costs me, I mean, it doesn't cost anything to start, like $3,000, but we paid Perkins Coie during the pandemic when we were starting this new structure, about $250,000 to put together a master series LLC structure. And that allows us to, and again, we're just equity allocators. You're going to be taking down these assets. And if you're going to be, the best part to use a fund for is if you want to be an equity allocator. Even then, I still prefer the SPV structure because, the expenses are different. And it's also, you got to think about it too, is that unless you're really good at raising money, you'll probably be using a 2 and 20 model, which really doesn't keep the lights on today. I mean, honestly, depending on, how things go. And so it becomes very problematic and prohibitive to really, you always have to be in, it's a different, you got to have a different incentive model. And, I know if people stick with me through this, I'll give them a free copy of my book and I'll tell them how to contact me. But what I did was during the pandemic is that Wall Street never met a fee that it didn't love. And I had to put together an asymmetric fee structure so that the investors would see, hey, I want you to put more into this. Here's why. And really what you want to do is you want to dissuade the bigger whale investors, no matter what you're doing, whether it's a fund or an SPV, to feel as though that they're not subsidizing the smaller guppies and suckerfish on the duration of the investment. And also, there's been inflation in service providers today, accounting, legal, fund administration, all of that stuff. The 2% is not really doing it anymore until you hit critical mass of over 100 million. And if you're just starting out, which probably many people listening to, you're not, but many people are listening to, they're not going to be able to keep the lights on and quit their job. We have a different, expense contribution that costs a lot of money to do this through Perkins Coie. However, it works, but it also provides, it's more of like an all-you-can-eat fee structure where the guy with $1 million is incentivized to put $1 million in, because if you look at the math on it, he's going to be making on average about 85 basis points more on a cash-on-cash return, because he's not doing it 2 and 20. Does that make sense?
Yes, it does. Okay. Yeah. And 2 and 20 for listeners, 2 points on the assets under management fund fee. Correct. And then the 20 is, educate me on that, referring to, is that the spread on the split?
That's the carry. Yeah. That's the split. Yeah. That's the split. That's how the beans are split, right? Some people put in there like, okay, it'll be they'll put a 7% pref in, and then, the best way to really put this into a visual format is think about it as like a pie. All right. They call it the beans, but let's pretend it's bean pie. All right. Before we split any profits, you as an LP with a preferred return, you get 7%, a slice of 7% first, and then the rest is divided on a predetermined schedule. Yeah. It works for certain circumstances. But today with the people starting out, that's not anything etched in law or in the Constitution. You can have any structure you want to use. That's creative real estate. That's why, deals get done all the time, especially in down markets right now. You got to understand to balance out how you get paid and keep the lights on and not risk your family and your marriage. Versus, getting involved and, having to work a job just to keep the lights on. I've seen people do some bad things over my past 20 years in this business. So it's, and I wouldn't say bad things as far as nefarious, but it's bad things as far as making bad decisions, overpaying for stuff. I was on a podcast earlier today. This guy said he had to drive 2 hours down to Fort Myers for one of his duplexes. And I asked him, like, why don't you have a management fee? And he goes, well, I was doing the math. I forgot to mention the management fee. And so, he couldn't afford it because he, paid too much for it. Right. That's what happens when you have low interest rates. But anyway, I digress.
Yeah, right. Well, for listeners, we're going to zoom in on multifamily. This is the Apartment Gurus, and I promise you we're going to get to that. And Sal is an expert in all that. But I do want to just kind of geek out for a sec on your views on just the whole opportunity set out there. We talked a little bit before going on the air about, a project that you're into. I think just to start, kind of given all the, we've had interest rates, quadruple, quintuple, or whatever.
550 basis points.
Right, right. It's coming from essentially one or wherever we were, or less than one. Yeah. So in that sense, we've met as we met up. So things have changed, obviously, in the equity space. LPs, we found, are in a very different mindset than they were 2 years ago in our space, in the multifamily space. And we can talk about why that may be and whatnot. But, what are you seeing kind of, globally, nationally? And by the way, just to highlight one of your points, living here many listeners know that I'm here in Mexico and recording remotely from Mexico. I'm here working on a kind of a work relo plan for about a year, and near the Puerto Vallarta airport, which puts me in the United States in a couple hours, which is super nice. So like, until you've lived somewhere else and really get the perspective of like looking back at the United States, I spent 50 years in the United States. You don't get how it really is where everybody wants their capital to end up or their capital to be, right? It's still the best bet, and in the investment world, globally speaking, from my perspective, and that's become abundantly clear living out of the country. So with that in mind, and just kind of general market conditions in mind, and what you are personally excited about, what are you seeing out there?
The U.S. is still a safe place for rich people globally to invest. It's the United States has turned from, an economy of, industrialist merchants really is in our history to, it became the financialization during 2004. That's when the Real Housewives of Orange County came out. And now what is changing to, I think, is it's going to be a destination country for capital and rich people. That's really what it's going to be. Yeah. And I'm kind of bullish on, several asset classes working on that. But I think, if we were to look at, the macroeconomic story here, there's a lot going on right now. You've had a lot of black swans come in. You actually, you've had a hit on an president. It's sort of shaking the world right now. Yeah. And it's going to be interesting to see what happens between election day and inauguration day. Those 79 days are going to be pretty tight. What I think is, as far as the global economy is concerned, is that there's still a lot of people who are looking to get into real estate here in the United States. And, if you can source that capital and talk to them differently about the reasons behind it, you're going to have a lot more fun. I think for multifamily, it's safer now to get into it than, in 2020, 2021, because it's already bottomed. I think, rents are starting to move up a little bit, stabilized. But, when people don't understand it, and especially the LPs, they're not sophisticated. They only watch, the talking heads on CNBC, or what their brother-in-law, who's a doctor who makes more than they do, knows. But now's the safest time to get into multifamily, right? From a basis standpoint. And I think you really need to start talking to your investors like, look, 4 years ago was not smart, because interest rates were low. And when the banks are handing out money from a helicopter, that's usually not a good sign. However, you have a lot of private capital coming into the space right now that didn't exist during the last great financial crisis. And that is sort of balancing things out. Things are trading. There's more sophistication there with that, private credit that's coming into it, but they're also moving faster. So, if a bank was willing to give you, I don't even know what it would be for a multifamily. Let's say they were going to give you 85% LTV. These guys will come in and they'll probably give you something similar, but a much lower basis or a much lower value, right? Mm-hmm. So the values have changed and everything, but they're going to get into it. Maybe they'll be a little lower, but these are the same guys too who are sophisticated enough to come in and also provide the debt and the equity. Yeah. And that's really where the real deal making is being done today. I think, wages, and unfortunately, and I really, the one thing that really bothers me about the United States is that we're a country for many, many years that has prospered and had a prosperous middle class because of oil. Okay. And regardless of what you hear about EVs and anything that's green, there's not enough there to power yet. And it's still the people who run the oil and the spice who rule the world. And, the geopolitical issues happening right now, if oil were to spike to $300 a barrel, that could cause some headwinds, right? And I think that's going to be a problem, because this country was not built for or on $500 a barrel, oil, or, maybe $50 at the pump. It's just not going to happen that way. So that's the only thing. I think, that'll never get to that point. I think it could be kind of pop, but I also think that stronger heads prevail, and that's going to keep things from really coming to a reckoning, but it could happen. And of course, that goes back to everything Warren Buffett said about, weapons, financial instruments of mass destruction. It's the derivatives off of that are multiple. And derivatives are nothing more than side bets, really.
Do you worry about currency, like a currency crisis, much? I guess for listeners.
Why? Well, I mean,
it's specific to oil, right? So, like, if the currency that oil is traded in were to change from the U.S. dollar, which
to what?
I think it would be the ruby or the Chinese, the yen, right? I mean, I can't imagine what else it would be. But, if we had that kind of geopolitical power shift, that they had the leverage to somehow leverage a currency change in the oil space, that seems to me to be like just the complete reset. But
removing the petrodollar, it could, but it's going to take a lot to get there.
Okay.
It's going to take an awful lot to get there. And nobody trusts the BRICS. The BRICS don't get along with themselves. The only alliance you see is Russia and China. But at this point, nobody really, the Chinese economy is in such shambles right now that everything's actually migrated to India and Vietnam. And I told you before, I don't know if we recorded, but I'm meeting with several Vietnamese Asian families after Labor Day who have a lot of money because of the repatriation of a lot of manufacturing. So nobody's going to want to put their money in a currency where it's a command economy. It's still kind of communist, but you have demographics that are not really on your side. Demographics are destiny. And that's really what the point is of this is demographics is destiny. The other thing I like to look at, being cynical at best and paranoid at worst, is you got to look at the dirty money. What's the dirty money doing, right? The dirty money is not transacting in crypto, right? They're sending, Louis Vuitton steamer trunks through London's Heathrow Airport to the Americas, right? Wrapped in greenbacks and $100 bills. Not crypto, right? Not crypto. Right. Everybody said, and crypto is very traceable now, more so than ever. And that's why it's become adopted more as a mainstream sort of asset class. And that's why you have the BlackRocks and everyone getting into it. However, when you have $75 trillion in US dollars being sloshed around the world in a swift transfer each day, meaning wires and everything, that's not going to change. It's just, there's nothing that's really going to change that. There's going to be challenges to it, yes, but I just can't see anyone, transacting Russian. I mean, are you going to accept Russian rubles for one of your, apartment complexes?
No.
Okay,
but if I owned an oil platform in the Gulf of Mexico, would that change?
Because you need oil. It's like drugs. Okay, you need. I mean, you're going to pay the currency for it. No multinational. No multinational is going to accept Russian rubles any more than you will.
Okay.
For apartment complex. I mean, how are you going to explain that to your investors? Hey, we got a buyer. He wants to pay in pesos. And then there's a currency arbitrage. Like, they're going to think you're using needle drugs. Yeah. It's just, you were very, very far from that happening.
Needle drugs.
Yeah. I mean, honestly, and that's why the U.S. has had so many bases around the world, is to protect the power of the almighty dollar.
Yeah. Yeah. It's good. Which is another whole conversation, as is crypto. We won't go down either of those rabbit holes here.
Another podcast, though. I mean, I'm surprised you let me on a third time, but I appreciate it. And, I'm an acquired taste for some people, and I appreciate your.
No, I mean, honestly, the value that came out. I'll just mention again. The last episode was Sal, and we'll put a link in the show notes. And the episode number is it's a masterclass, and so of course we have you back on here.
Sure, yeah.
So in relation to the conversation about how American real estate, U.S. real estate is a darling globally. How do we explain? I don't know how many trillions in dry powder is sitting on the side.
Yeah, there's a lot. There's a lot, and there's a lot more that's pent up too as well. I was speaking with an Asian gentleman of Asian descent. He went to MIT. He's from Hong Kong, and he's asking me questions I don't know the answers to, or if I do, I won't tell him. But it's like, how does he get the, Asian money in from, into the United States? And it's not that easy. Mm-hmm. And I can tell you that it is, if you worry about currency controls, these people are paying brokers like 10, 20% to move money.
Wow.
And these guys make money, whether it's, captured or, seen as like a fraudulent and then it's confiscated. I mean, it's just insane what these people are doing because they've created so much wealth in these Asian countries coming over here. So yeah, there's a lot of money sitting on the sidelines, of course. I think the trillions in dry powder. I mean, I can't believe we're using the word trillions, but this is what happens after a pandemic. Everything sort of has added a new zero to it, and people have created a tremendous amount of wealth. But the values over time, I think, are going to be, and I saw this happen in New York City, but it's not going to be crazy to see like cap rates go below the 10-year, in certain Class A apartment complexes in, tier one cities, like, because different capital needs have different needs and wants. And for the United States, anyone who's been in real estate for the past 10 years knows that there's been a lot of foreigners, especially in New York, that have bought things sight unseen, overpaid for it, and never flipped the light switch on because it's a store of wealth that they can secure and insure. And if you can tell a story and you have access to that look, now's the best time to invest in multifamily because everything is bottomed. Now you have a different story, you see. And I think, a lot of people follow the herd mentality. A lot of LPs are stupid. I mean, I'm being honest with you. They just, my brother-in-law told me this. Nobody wants to do research on their own. But really what it comes down to it is that, and you know me, I'm not a big multifamily guy, but it's hard not to resist a siren call right now of multifamily, even though our deal book is full and we're not looking at it, because I feel as though this is the bottom of it now. And you look at a lot of institutions going in, and some of them are giving back the keys, but the other pocket, they're, accepting large AUM contributions institutionally to be able to buy huge apartment complexes, right? Mm-hmm. And, they're not condoizing them, but, at some point could happen if rates go low again. And I wouldn't be surprised to see that, New York becomes a condo island. And we've always called it Millionaire's Island, but I mean, it's just a store of wealth for people overseas who are not looking for, they're already rich. They're not looking to get richer. But the problem is they have no other opportunities that they know of than working with a sell side real estate broker or realtor selling them condos, right?
Mm-hmm. Yeah. Let's zoom in for a sec on equity sitting on the sidelines. From your perspective, the equity that would be that is sitting on the sidelines that you and I both agree, and we'll talk about the multifamily market bottoming out a little bit here in a sec, but the a couple trillion, I think, is maybe where we are in terms of what people like to say is in the sitting on the sidelines in the way of dry powder. Mm-hmm. And I don't know exactly how that's quantified and what asset classes they're kind of, pinpointing there, but
non-bank, but yeah, let's just say non-bank. Okay.
Yeah. So that said, I mean, what do you see as? I mean, who are the people sitting on the sidelines? Are these the $100,000, $250,000 LP investors? Are these the $10 million equity checks?
These are family offices, $100 million plus in assets. That's really what it is.
Yeah. Okay.
That's and also like sophisticated funds, Blackstone, BlackRock, the typical players, Goldman Sachs, Carlyle, that type of stuff.
And it seems like those are the ones that should know better. I mean, to your point of bottoming out in the multifamily space with, Neil Bawa.
No, they're getting into it. They're getting into it now.
Oh, okay. Got it. Right.
They're getting into it now. And that's usually a good sign. And you can use that in your pitch decks and say, look, these guys are buying this. They're buying it at a strong basis. They're smart guys. They know what they're doing more so than the CPA or dentist who wants to play a GP for the first time.
Yeah. Yeah. Okay. Great point. Specific to multifamily, we are we're in a deal right now that it's kind of a twilight zone deal. I'm calling it, especially in terms of the equity requirement. We've got a $4.5 million equity requirement, so not a big deal, right? And what that does is it puts us right under kind of a threshold for, like, say, an institutional family office private equity source. Mm-hmm. That likes to do at least $5 million, more often here, $10-20 million minimum check sizes.
Yep.
I'm not even sure what my question is, except for that we put ourselves, we love the asset, institutional all over the place, except for scale. It's 72 units, 10.9 million acquisition, but 2015 build, 9-foot ceilings, great amenity set, et cetera, et cetera, et cetera. Great debt, great management. Really checks the boxes in, a growing submarket on the belt loop of Columbus. So, given that, what do you see as, like, I guess I have a couple questions. Number one, what do you do if you're in our shoes right there? And I ask that because I know that a lot of listeners are in, even if they're bringing in a pref piece, they still have to raise 3 million or 2.5, 4 or 5 million, whatever it is. And then number two, I'd love to also get your follow-up thoughts on like where we go next as Greenlight. And I have some thoughts on that, right? This is a stepping stone deal for us. It's I
think it's the last deal you'll do under 5 million equity going forward. Because what's going to happen is that when you're still working with the smaller LPs, it's like catching flies in a birdcage, right? And so, for that, you're just going to be with like rich guys, and there's ways to sort of frame it. But what I would do is and again, talk to your lawyer about this, okay? But what I would do is to facilitate this very, very quickly is I would put together an asymmetric fee schedule immediately for that SPV that's going to hold it. And what it is it'll be like, look, it's a one-time fee. There is going to be like a small management fee, but that won't kick in until later on. But this will be enough for you to get the fund administrator and say, look, we need, I would say, that our capital partner wants us to have smaller, larger investors. In order to incentivize this, we have an all-you-can-eat fee of, say, $15,000. Okay, so that means that the whales feel more comfortable, but it also compels other people to actually invest more. So, you don't want the 50,000. You're going to get a few hundred thousands. You can prorate them to 6 if you want to. I would say the minimum investment is 250, but I would also start telling these people, and this is something that is really interesting and why I don't really like the fund structures, because once you take that money, that dry powder, you have an IRR clock to your head, right? You have to start producing a return.
Right.
So what I've done is I partnered with several IRA custodians, and I tell people, and we're doing this right now with a real estate deal with families that have large pension funds. And I said, look, you got to start putting this into a tax deferred vehicle. Start moving this money now into this, preparing for our next Class A deal that's coming up. And I was like, well, what does that mean? So once that money moves from where it is, whether it's at JP Morgan or Schwab or Fidelity, over, and especially with the smaller investors, have them move it over to a self-directed IRA. Because this is a hack. Because once that money moves into that self-directed IRA or is transferred over in kind, it's like the Roach Motel. It's never going back. So now that money is just sitting there, holding, waiting for you, and they're climbing on your back to say, "Hey, Tate, what do you have? You told me to transfer this. I have, $500,000, $750,000 in my retirement waiting for you in your real estate deals. I thought you were going to have one. Hold on, it's coming. Patience, trust me." And at that point, you'll have a lot more opportunity to work with that, because people will be much more ready to write you the check. If you start going around, you start pitching the deal. For not you, but for other people who don't have experience, what you have to do is you have to find the investors first before you find the opportunity. And that's the most important thing.
Yeah.
And that's really what I talk about. We talked about calling the capital, is to start building relationships with these smaller investors. Everybody knows social media today. Attention is the new oil. Get on top of that, put together an email list and start talking to these people like you do, Tate, right? I get your emails. They're great. But if you start balancing it and start talking to people and having these conversations with different emails saying, for this deal, we changed our incentive structure, so that the bigger investors, and you can model this out, make 85, basis points more on a cash on cash return, not IRR, because you can't eat or buy a Mercedes with IRR. Mm-hmm. Then that all of a sudden makes people more interested. They're like, "Ooh." And now they're telling all their friends that they have, disproportionate interest, and you don't have to worry about pref or anything like that, because these guys are going to be making more money anyway. You can still give them the pref. You complicate the waterfall as much as you want, but when you're dealing with smaller investors, they don't know what the hell pref is, and you have to explain to them what that is. I've been through this before using the Dutch auction technique. It had, my second fund was we were buying fractionalized first trust deeds from hard money lenders, and we were using a Dutch auction technique to do it. And I had to come up with and it took a lot of brain damage to do it. And finally, Tate, it was, look, if you're an LP and you haven't gotten paid in a year, 3 years, look, how much do you want for your stake? Nobody will ever make any more money than you will. So if you say 7 cents on the dollar, the market's cleared at that. If we get 51% of that, then everybody else gets that regardless. And, we were able to be successful with it. So, I would just put it in a way where they can actually talk to their spouse about it. where they can actually, communicate to them and saying, look, it's an all you can eat fee in a way, because people are visual thinkers. People think that way. If you start using all this technical jargon, I can tell you, even working with families who've just gotten $50 million exits who are tech and life sciences, they have no idea what the hell you're talking about. Mm-hmm. So you have to communicate it to them in a way where you're actually educating them as a, consigliere on their side and saying, this is why we put it together for rich guys like you, Tate, not the guys who, are taking, and I don't know why the hell they do this, but, they're taking like $10,000 investments. You can't make enough money to, it costs money to manage money. And that's what a lot of first-time GPs and sponsors don't understand. And that's why a lot of them struggle, not because of the performance of the asset, it's because they have to wait so long for the asset to come online and many good things to happen before they get paid. But if they were to just change their fee structure in a way that, benefits bigger money, then they would be a lot more well off. And, I talk to a lot of people. I advise a lot of people on that. And, it works well because it allows you the runway to do what you need to do to set things up and to pay yourself.
Yeah. Yeah. To circle back to one of the things you said, and this is no secret. We've talked about this before. Multifamily is not necessarily your favorite asset class. Could you speak to that for a second in terms of the whys there? Is that a product of your network, the interest level of the family offices and other institutions that you work with, their appetite? Is it you personally? What do you see there?
It's all the above. A lot of the families I work with, we have two groups of investors. We have true family offices, which by definition, economically speaking or quantitatively speaking, have at least $100 million in investable assets. Okay. That's whether it's they inherited it, whether they sold the company, they've made it themselves. And then we have what we call the NREs, which are people who are less than that. They're not rich enough. And those are guys who are a little different, and the NREs.
Yeah.
And, they're like, maybe 10 to 25, like somewhere maybe, on the lower end of the barbell, but, they want to be interested and they want to go into it. The problem is with multifamily is with the bigger families is that they're already wealthy and they're not looking to take on any more additional risk. They would rather get in and say like a Class A industrial underwritten to an 8 rather than, an apartment deal with a value added, not you, but like a, value added operator, first time operator, where a lot of good things have to happen before they get a paycheck. Right. And I think when you look at multifamily, it's a great wealth creation vehicle, but it's not, and it's great because you have the government that's helping you, with GSEs giving you the loans and everything, because they really do want you in the business.
Yeah.
However, those tenants have different rights and remedies, as we've seen through the pandemic, which make it kind of prohibitive for landlords to affect evictions and things like that. So, they're sort of scared of that. And not only that, but today with the interwebs, anybody can do a deep dive, and then you're shaming people, and there's, what we call headline risk. And so, a lot of these families that I've known since leaving Goldman Sachs would rather streak naked down Broadway than to say that, have a bunch of people standing outside their house like a politician, throwing oil and paint, saying, greedy landlords, hiking my rent. Yeah, all of that. So it's just it's a matter of what it is. And like the middle class investors, upper middle class investors, they don't have a network, right? They just have their job. They're mostly high income earners. So they own a business, which throws off some cash flow. But all they know is that they're involved in their business 50, 60 hours a week, whether they say they work 40 hours a week or not. And then they have their families outside of that. So they don't have time to develop a network to be able to go out there and meet guys like you and me, really, unless they listen to your podcast, if that makes sense. But, for the most part, just getting involved in these deals takes a tremendous amount of trust because, these smaller investors might have money, but nobody trusts them because they're small investors and they're usually pains in the ass and they don't understand it. And usually, just like anything else in life, the people, the smallest, what is it? It's like the emptiest containers make the largest noise. Is that like a Texan saying, I think, or something like that?
Yeah. I've never actually heard that, but I know your point. Like, somebody that comes in on a $50,000 minimum, which is, kind of the realm we started in when we were doing Class C value add and, $5 million acquisitions. Like, they come in and they say, well, I can't do 50, but I can scrape together 25, 30. Like that's kind of the last investor you want to have in your deal because they're the ones
they're desperate and they don't have enough. And, I can tell you, like, we get, I mean, listen, I know everybody listening to this has been some important guy, but if it wasn't for, and I'll just put this into the category of our venture investments, we were invited to SpaceX and to Stripe, which we're finalizing right now because people trust us. Okay.
Mm-hmm.
Like, these institutions are like, I can rely on Sal. He'll give me a number, he'll get it a level, and we'll clear. And I can trust him. With some guy I don't know who's like, oh, I got this, and he's got a lot of flash, he's probably indebted, at least $400,000 in student loans, or maybe, something else. He's got a very conspicuous lifestyle, but is he trustworthy enough to come up with the cash? And the answer is usually,
probably not.
They don't. Capital is a commodity today. Everybody's got it. Yeah. Everybody's got it, but not everybody can be trusted. And that's why today there's more of a focus on interactivity and trust with the investors.
Yeah. Yeah. You mentioned, I knew you were in the Stripe deal. Is the SpaceX deal a live one for you as well?
Yeah, that's a live one as well. These deals, I mean, you're dealing with household names, right? And these companies are very, very profitable already. I mean, SpaceX, to us, we love. I mean, when we were underwriting that, we learned so much more about space than I ever thought. But when you think about it, if he were to spin off Starlink, which is, the most profitable company, we're getting the space company for free. So, we'll probably make like a 3 or 4x on Starlink, should that be spun off. And then we get the payload and the Department of Defense, all that kind of stuff for free. And that is, I mean, that's going to create more millionaires than I think Tesla.
Yeah. Wow. Yeah. Yeah. There's another rabbit hole right there is the man himself. And
we can go down that. You know what? And to be honest with you, because we were very good Boy Scouts with SpaceX, we'll probably be invited to participate on the cap table in Neuralink.
Okay.
So,
yeah. Well, and I mean,
the way it works.
Starlink in particular,
$1 guy, nobody would pay attention, right? So,
full disclosure, this show literally would not be happening right now if it weren't for Starlink. I've got the 1 terabyte connection on my roof here.
Do you really?
Yeah.
Look at that. You look at me. I mean, I thought you were wired in, but hey,
no. And it's, I mean, I had Google Fiber in Utah, and it is every bit as good. Probably technically a little faster. And very, very real. I mean, they've got it down. They really do. And it's, arguably could be, you could argue that SpaceX, Starlink, about as important a company as there is on the planet. Maybe NVIDIA gets in there, but,
well, I'll take it a step further. I think it is going to positively impact real estate values because you're going to start to see people being able to live in remote areas that they never thought they would be able to be in. And as an example that comes to mind is, along the, I can't remember, I think it's the 15 from Las Vegas to Bakersfield or, to LA. I mean, you have that is going to be fully developed at some point. It's just not going to be, aging airlines and there's
a train. They have a train lined up for that route, don't they?
Yeah, they will. But think about it. Like you would move somewhere. I mean, your move, this changed your life. Think about it. And you don't think that that's going to have an influx on value soon because you now have access to the web. I mean, now you need that and Stripe and you can make money anywhere. Yeah, literally the sub-Saharan desert, right?
That's a good point on Stripe too. Yeah. And yeah, I mean, the beauty of Starlink is it is the same everywhere on the planet as far as quality, reliability. It does not matter where you are. And by the way, there is no way I could be where I am, in a little surf town on the Pacific coast of Mexico without Starlink. The infrastructure here, that it's not the local providers that are deficient. It's just the general infrastructure just would never support a stream like this that we're on right now. So it's an essential part of my, my world and my infrastructure here, allowing me to do what I do. That interesting point too about the globalization of access. And, we've heard the stories about tribes and whatnot, but
yeah, I mean, Starlink and, if you look at SpaceX as a whole, they have a monopoly now that this country has not seen since Standard Oil. And it really makes me bullish on American ingenuity. I love it, but for many reasons as it relates to, the ability for our technology and innovation to continue to go on. So if anybody's worried about America dying in the innovation, what you should do is you should spend a week in Palo Alto, which is where I might be spending some time before things get busy in Miami again. And as it relates to Art Basel and stuff like that. because we love the vibe over there. We love everything about it. And you have 15 trillion in market cap at 7 companies. It's just, there's a lot there. There's a huge concentration of wealth there.
Silicon Valley. Yeah. And I mean, well said. And I'll just mention it. Just coming to mind is our Columbus market, where we're really, that's our sole focus these days in terms of deal flow. We've got a $28-29 billion Intel chip being funded by the CHIPS Act that Congress passed. We've got a Honda EV factory being built next to their current factory in Marysville, and Google's building a data center there. They're calling that the Silicon Heartland because of all the smaller tech companies chasing those big installations.
Oh, I'm very bullish on Columbus. Yeah, I mean, and you're starting to see that now, where you're starting to see with the repatriation of chip manufacturing. And I know that's not what you mentioned, but with Intel moving there and other
that's
things.
That's basically what it is. That's exactly what they're doing. Yeah,
because there's smart people there, right? You have universities. You have a lot there to draw from to be able to build that infrastructure. Not everybody has that to their advantage today, unfortunately.
Yeah.
Or every city.
All right, so back to multifam for a sec. As far as you mentioned, this will be probably the last deal that you do under $5 million in equity requirement. And there, you took the words out of my mouth. I've been saying that since we put this thing under contract, and maybe even before. We do very much see it as a stepping stone into this. It's very much an institutional asset for us, except for scale. And so for us, we're looking 20, 30. $40 million type acquisitions coming down the pipe for us next. Newer assets, nice tenant bases, great amenity sets, et cetera, stabilization in place.
Amenities. Yes. Stabilization and amenities. That's what sells.
Okay. So, when you think about your groups, your family offices, what, if they were going to bite on a multifamily deal, I mean, let's just start with size, like, purchase price, valuation. What do they like to see there? What kind of check do they like to cut?
The minimum that they like to see in those things are usually around $10 million equity check size. All right. And that's enough for a guy like you to work with one guy in a JV.
Yep.
And that's really what you should be aiming for. And I can connect you with networks where you can talk to people who are like this. Who I've been working with for over 20 years, but you gotta make it sound a little more robust. Nobody wants to deal with the smaller. This is the perceived thing. When you're dealing with smaller assets, you're perceived to be dealing with smaller, inexperienced, unsophisticated investors, and big families don't want to be around that, which is why they don't crowd fund anything on any of these crowdfund sites. Like, nobody wants to, these guys, that's really just like a gamble. I don't think anyone's ever gone public from like a crowdfunded site, but like minimum investment, $250, $1,000, $500. It's why do you want to be in the same pool as that? Right. And so that's a lot of noise. That's a lot of discretion. That's why these guys, they just want to see, okay, this is major. This is big. Tate sings a great story about Columbus. However, the asset's too small. And I think, for them to get interested, they would like to do that. I would seek out family offices who would like to see that, who are bigger families, maybe in New York, who want to go into other areas because they all allocate to different places too as well. But I think, if you're bullish on Columbus, you should be, putting out content all the time, talking about why we like Columbus in 5th grade language to people, right? Talking about the university system there, talking about Intel, talking about the repatriation, talking about how, geopolitical things have changed where now everything's moving away from China and they're moving into other areas. And now, because of AI, Columbus is going to be one of the ultimate beneficiaries of that, in the Silicon Heartland. And if you start telling a story like that, that's fine. And then the burden becomes on you to find the asset big enough for these guys, to invest into. But that's all through the networking and everything. And a lot of people don't spend time networking. And the second rule of real estate, but none of your listeners do. The first one is, of course, location, right? The second one that I learned at Goldman Sachs was always be raising capital. If you're in real estate, you should always be raising capital. And that means spending a disproportionate amount of your time talking to current investors and new investors. We have current investors in deals that are not in real estate, but they're waiting to get into our real estate deals. So, I practice what I preach. I spend about 50% of my time. Even if I was just starting out tomorrow, I would spend still the same amount of time, probably even more, talking to investors, both current and new, and building those relationships and telling them what you got down the pipeline. Calling your biggest whales and saying, hey, this is a big deal. I'm going to give you something very special here. I have something that I'm putting together where it's going to penalize the smaller investors, although you don't put this on an email. This is a one-on-one, but it's going to reward the larger investors. And, with a minimum investment, I've modeled it out. So you should receive about between 45, on the low end to 84 or whatever he puts in. It's just at that point, he puts in 10 million, then he knows it's going to be different. But it shows an alignment of interest here, and it allows me to work with a few bigger investors rather than smaller investors. What do you say? And I would just put it over a series of like 4 different emails of how you change the fee structure, how you've done, and everything has a call to action with a deadline. And then you call up and you follow up with these people. Just don't think, you got to call these people. Anyone can blow you off in a text or an email, right? No, I didn't get the email. Oh, I didn't read it. It's automated. Well, I demand people read my emails. I said, look, it's even in the docs too. If you invested with us, some people have a lot of money with us, Tate. And I said to them, why the hell did you unsubscribe from my email? Like, I'm like, you have more money with me than and you should probably be asking for my biometrics, to be honest with you. Like, don't unsubscribe from the emails, because the more, and I'm talking not to you, but the people who are starting out with this, attention is the new oil today, and interactivity is the new currency. And everybody is so distracted with, all sorts of beeps and everything going off on their WhatsApp and their email and their text messages and their loved ones. And everybody's got a different beep, and everything happens. People sort of reply to that now with a sense of urgency or not, depending on their personality. But you need to be on top of that, raising money. And before you get into this real estate business, you should have some coaching through Tate, of course. But the point is that I think you need to be able to learn how to raise capital first or sell and persuade people, rather than going out and finding a deal and then trying to find investors to go into it. That never works.
Right there, the takeaway, put a gold star by that one. Always be raising capital, always be networking, always be talking to investors, always be priming that pump, right? And it's capital raising 101. And in our space, it's incredibly important for listeners that are building their portfolio, like we are at Greenlight. We've got about 80 million right now in assets under management. We're still kind of a smaller fish, and that conversation right there is incredibly important. So Salvatore Buscemi, talk about your book, and you mentioned a freebie on that.
I got a freebie. So anyone listening who wants an autographed or audible version of my book, Investing Legacy, how the 0.001% invest, send an email to sal@investinglegacy.com. Also, I have another guide, which is probably more important to you guys. It's Calling the Capital. Again, you can email me, sal@investinglegacy.com. That's SAL, not SOL. And what I'll do is I'll get it out to you. We have audible versions of Investing Legacy. I would suggest you go with both of them, but Investing Legacy, if you were to read it, the other one's a guide, but Investing Legacy talks about real stories with real family offices discussing why they like working with us in some of our deals.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.